What is the best exit strategy for a put-debit spread? Have you ever wondered how to maximize your profits while minimizing risks in options trading? Today, we are focusing on the best exit strategy for a put-debit spread. A put-debit spread is an options strategy where you buy a put option at a higher strike price and sell another put option at a lower strike price, both with the same expiration date. This strategy creates a net cost to enter the trade. The aim is to profit if the underlying asset's price declines, but with limited risk and limited reward. To effectively exit a put-debit spread, you should consider several key strategies. First, set a profit target before entering the trade. This target should be based on your risk-to-reward ratio and current market conditions. For example, you might decide to exit once the spread reaches 50 to 75% of its maximum potential profit. This helps you avoid holding the position too long, which can lead to losses due to time decay or price reversals. Next, use stop-loss orders to limit your losses. A stop-loss order automatically closes your position if the underlying asset moves against you beyond a certain point. This is essential for protecting your capital. Remember, the maximum loss on a put-debit spread is limited to the initial cost paid, but it can still impact your account if not managed properly. It is also important to monitor time decay and volatility. Options lose value as expiration approaches, so consider how much time remains. If the underlying price is not moving as expected and expiration is near, it might be wise to exit early to salvage some value. Additionally, changes in implied volatility can affect option premiums and the spread's value. Another strategy is to consider rolling over the position. If you still believe the underlying asset will move in your desired direction but expiration is approaching, you can close the current position and open a new put-debit spread with a later expiration. This extends your trade duration, but be aware that it involves additional costs and commissions. You should also exit when maximum profit or near maximum profit is reached. The maximum profit of a put-debit spread occurs when the underlying price falls below the lower strike price at expiration. If the spread value approaches this maximum before expiration, it is often wise to exit and lock in gains rather than risk a reversal. Lastly, adjust your exit strategy based on market conditions. If the underlying asset shows signs of reversing or if volatility spikes unexpectedly, consider exiting early. Being flexible and responsive to market changes can improve your overall trade management. In summary, the best exit strategy for a put-debit spread involves setting profit targets, using stop-loss orders, managing time decay and volatility, rolling over positions if necessary, and adjusting based on market conditions. This disciplined approach helps you optimize returns while controlling risks in options trading.